How are you doing? This is David W. Williams, also known as Diamond Dave, the founder of the highest paid part-time job in the world options training program. And what we're really quickly going to go into for our laws of game session is how to cash out on weekly options. And a lot of y'all going to hear this and be like, well, why are we talking about options on the laws of game? It's because I felt like I've already done a video earlier this week that didn't involve the market. So what we're going to do for this laws of game is we're going to talk about something that involves the market, but it also is game on the market, or how you can be more successful in the market utilizing this particular piece of information. And what we're going to talk about is how to cash out on weekly options. So this is for the 4th of July weekend. I want to tell everybody to be careful out there. A lot of people like to, they like to shoot off on the 4th of July. One of the biggest issues with that is those bullets got to come down somewhere. So, everybody be careful, just watch your surroundings, make sure you got some cover over the top of your head. So if anything happens, you don't got to worry about a shell hitting you on top of your head because you outside while these people is letting off. So let's go ahead and get into it. Now we're talking about how to cash out on weekly options. This is something I really try to get my students to understand, but I think one of the biggest issues is you got to get time in the market and experiencing this to really understand what I mean. So I try to make sure people have the principles, but a lot of times you got to get time in the market. So if you listen to this video, what we're going to just continue to reinforce is how to be successful utilizing weekly options. And one of the biggest obstacles of being successful utilizing weekly options is really understanding the actual scenario, right? Most people are trying to get success, but they don't understand from a full comprehensive standpoint, what are all the particular challenges that you may have in an area that you have to understand how to overcome to be successful, right? So they may see the goal, but they may not necessarily see the hurdles that they're going to have to go over to get to that goal. And I'm not saying that you shouldn't be optimistic, but you want to kind of understand everything from a 360-degree standpoint. So one of the things I teach people about the weekly options market is that I try to get them to understand that this market exists because of desire in the marketplace. And so what we're going to do is define weekly options first. What do we mean by that? We primarily mean options that you buy on Friday that expire the next Friday. So, it's 7 days, but really it's like a 5-day expiration date because the market's not open on the weekend. So what you see with a lot of what we call American options is that, the market's closed Saturday and Sunday. The options that they get created usually on Thursday, but sometimes on Friday. You buy them on Friday. They expire at 4 o'clock that next Friday, right? Now, why did this particular options market exist once you kind of understand what people call the Greeks? They exist because there's a desire in the market, excuse me, to buy options that are going to be less expensive and also that have a very short time expiration, because most people, they don't want to pay a lot of money for an options contract, right? They want to be in positions that they don't believe are going to cost them a lot of money to get into the position, and they want to turn the position around farther. So one of the things that I teach is that you have to understand how to manage capital. One of the biggest challenges in managing capital is how much capital are you going to outlay and what time horizon do you have for the capital? Most people cannot answer that question because they've never been asked that question. Okay. So one of the biggest benefits, if no other benefit, of dealing with me is I'm going to teach you how to start asking questions about how to manage capital. And this is something that you have to start working through because nobody's ever asked you. They just told you to purchase things. They never taught you about time horizon and how much capital do you want to allocate to this particular scenario. So when we're looking at the options market, they create weekly options. So let me give an example. You can look at some companies and they have only monthly expirations. And what that means is that there's not enough of demand for that company to create weekly options where the market makers create options on the weekly standpoint. So every week you got options expiring. So you can look at certain companies where their options only expire every month. So they have what we call monthly expiration. Every month, so you'll see a June, a July, or August. Sometimes it may jump into January. Kind of depends on what the market maker feels that there's a demand for. For the goal of the market maker is to create a market for that particular options chain. So what you see with some companies, especially me, because I be trading tickets that a lot of people ain't never heard of, is that they only have monthly options. When you're seeing really, really popular tickers, right, or tickers that become more popular over time, right? And I'm talking about the companies. I'm not talking about necessarily the indexes. You're going to see what we call weekly options. Now, the benefit of weekly options is the options chain is very, very liquid. Another benefit is you can avoid that monthly expiration. And I can, if you take my VIP course, I can really teach you why you may want to sometimes avoid the monthly expiration. But you can avoid that monthly expiration if you get weekly, right? Because you got options that are going to expire before and after that monthly expiration date. Here's the challenge of buying weekly options, though. When you're buying the option, what are you actually buying? So I'm gonna ask you that question again. If you understand how an options contract is set up, what are you actually buying, right? If you understand how an options contract is set up, okay? So when you buy a contract on Friday that expires the next Friday, what have you actually bought? Now, I know you've bought the option to do something, but the way the contract is composed, the elements of the contract, the terms of the contract, what have you actually bought, right? So then you want to break this down. Have you bought time? No, because the contract expires. Have you bought volatility? You may have. You may have purchased volatility, and some people purchase volatility. Now, if you are very confident that the situation will be even more volatile in the direction that you desire or that you forecast, it's not a big deal to buy volatility. But if you purchase volatility and then the situation becomes less volatile, right? You purchase volatility, right? The volatility starts to decline, which means you lose premium on the contract, and you also did not purchase time. You understand what I'm trying to tell you? So now the contract is against you, even if you get the movement that you desire. So one of the things that you cannot purchase with a weekly is time. Why? Because it's a weekly. So you're not purchasing time. And that's one of the reasons why the contracts a lot of times are less expensive unless it's a very, very volatile situation like maybe GameStop or AMC, where because the volatility is so high, the contract is still expensive if it's close to the money, even though you're not purchasing time. What you're just purchasing is volatility. So one of the things that I always encourage people to do is that buy as close to the money as possible with as much time as possible. So what am I telling you to do? You're purchasing intrinsic value, right? Because you're as close to the money as possible or at the money, and you're purchasing time. But a lot of times those contracts are more expensive. That's why I encourage people to get off the tickers that are more expensive and try to find contracts that are less expensive, because there's a lot of companies out there that have really, really, I would say, attractive price options contracts, but the crowd won't be on those contracts. They're not going to be the Teslas. They're not going to be the Apples. They're not going to be the GameStops or the AMCs now, right? But you got companies like Ford. You got companies like, I would say maybe Nokia. You have other companies that, I think GE at one time was one of these companies where the options chain is very, very liquid. The options are very, very attractively priced. And because of that, you can buy a lot of time and you can buy a lot of intrinsic value of the contract without having to pay a really high premium. So like an example, Tesla before it split was a very volatile stock. It was also a very popular stock. So what did the market makers do? They priced the contracts accordingly. So a lot of people could only afford weeklies. They couldn't afford to buy 6 months out. Now, if you were fortunate enough to buy Tesla 6 months out before it started really moving up after COVID, you was probably sitting on hundreds of thousands of dollars and not millions of dollars. And there was a guy I used to follow on YouTube. He was an older white guy. He had bought Tesla contracts to expire at the end of 2020, at the beginning of 2020. And, he paid, a few $1,000s for those contracts. And then what happened is Tesla, after COVID in March, it became very, very bullish. And he woke up one day and he was sitting on a few $1 million, right? So that's how it happened. Tesla before COVID, nobody really cared about that company. That's why it's always interesting to me how many people are Tesla fans now, because nobody was talking about Tesla in 2018. But then after COVID, once it hit profitability on that one earnings, it became very bullish. A lot of people started really buying into it. And then you started getting a lot of institutional buy-in because of the liquidity offered to the markets by BlackRock and the Federal Reserve. And then you started seeing those contracts becoming very, very expensive. Then what happened is, as a result, people started buying weeklies because they couldn't afford a 90-day contract, a 120-day contract, anywhere close to the money. So a lot of people was buying weeklies that was way, way out of the money. Well, that made a lot of money for the market makers and made a lot of money for people that was fortunate enough to own enough Tesla shares to write contracts, right? So you got to understand, when you're buying a weekly, if you're not buying at the money, you're not buying any intrinsic value, right? All your value is extrinsic. You're also not buying time because it's a weekly. Then you may end up just purchasing volatility. The problem with you purchasing volatility, if the situation does not remain volatile in the direction that you needed to remain in, the contract immediately starts to lose value. So that's what happens to a lot of people. They buy the contract on Friday. They're anticipating a really, really strong direction to move. They really don't understand the options market that well, and they really don't understand the market that well. Contract comes out on Monday. They don't get the anticipated move. What happens after Monday is that contract starts to lose a lot of value when the market opens up on Tuesday, right? Because a lot of times what you did is you purchased volatility. So if you purchase volatility, but the situation no longer is volatile in the direction that you need it to be, what happens? The contract starts to lose a lot of value. So you got to be really wary, because you can get seduced into buying weeklies because you believe that they're inexpensive. It's a reason why they could be inexpensive, but they also can be expensive, right? So I would tell you, if you're going to get into the weekly game, you can make a lot of money on weeklies. Make a lot of money. You can put a very low outlay of capital and get a really, really big return. And sometimes you can hit them out of the park. I've watched companies. I'm a company watcher, because that's my personality, right? I will sit back and watch a situation for a very long time and just keep observing it. So there was a time where I was watching Snow, which was a low float software stock. And, you watch the market makers, they push this company in different directions based on what they're trying to do, because they're working the trade. And I saw right before it hit lockup, it ran up, because a lot of times before lockup, they try to run the company up first because they want to get out at the highest price possible. So the market makers will run it up. It went from like 200 something to like $400 in like 2 weeks. I saw people that had weekly contracts. They paid maybe $200 for them. In about 2 days, those contracts was worth $10,000. That happens. The problem is, does it happen enough for you to take those kind of risk? Because it does happen. But does it happen enough for you to take those kind of risk? Because everybody talks about when it goes in their favor, but do they talk about when they lose money on the contract? Because like I said, you're not purchasing any intrinsic value unless you're buying right at the money, right? You're not purchasing any theta because you're not buying any time. What you're really buying is a lot of sigma of volatility. And then the problem is that if the situation doesn't remain volatile, you start to get what we call volatility crush. The volatility starts to weaken and soften, and you lose premium on the contract just because of that particular reason, for no other reason. You can get the direction of move you want, but if it's not very volatile, you can start to lose premium on volatility crush. So you got to really understand the market and how it works, and very much understand that particular scenario. And one of the ways to really understand that scenario is to take a particular company and watch that company, or have spent enough time in the market where you kind of understand, based on how this company's set up, based on institutional ownership, market sentiment, things of that nature. This is where I believe the directional move is going to be. And this is the strength of the directional move, because you can't just get to the directional move that you want. There has to be a certain amount of strength behind that directional move. Let me give an example. Last year, I want to say around this time, maybe, because, time is flying. Kodak moved up. Well, I knew Kodak was going to sell off. Kodak was a $5 share company. Kodak moved up. It got around $30, $40. I know it popped up to 60, but it came right back down. Got around $30, $40, right? This was on a Wednesday. I watched it sell off on Thursday. Around Thursday, right before market close, I bought put contracts going out literally. I want to say my first batch I bought probably went out maybe 3 or 4 weeks. Now I bought a lot of theta, and I bought a lot of intrinsic value because I pretty much bought at the money. But I also purchased a lot of volatility, right? Then Friday, it kept selling off. I bought more contracts, but I bought these a little bit farther out of the money, right? Bought these maybe $6 or $7 out of the money at that time. But I also bought a lot of expiration date. I bought a lot of theta. I bought a lot of time, but I also purchased a lot of volatility. Now, these were not weeklies. The issue was that on Monday, it sold off, but then it started trading horizontal the rest of the week. So what was happening? I was still making money on the premium because I didn't get the volatility that I purchased, and it didn't remain volatile. The premium started to flatten out because the volatility started to flatten out because I purchased volatility. You understand me? So I'm purchasing that this situation is going to still remain as volatile going down as it was going up. And what happened was day traders jumped into that particular play. They started trading it and they softened out a lot of the volatility. I learned from that play because I had money tied into that play. I had so much capital tied into that play. I couldn't go into Tesla, and the Tesla play would have been a lot more lucrative for me over time. But I had my money tied into, and I'm thinking, okay, well, tomorrow's the day it's going to just tank. The next day, tomorrow's the day it's going to just tank. And what I should have done was pull my money out of that play because I was already at profit. Should have pulled my money out of that play and then put that money into Tesla, because Tesla at that time, it had the most opportunity because that was going to become the next volatile play. And I knew it, but I had all my money tied into Kodak, and I was waiting for Kodak to fall to like $5, and it didn't happen. Kodak just, went down $1 a day. So I started losing a lot of premium on volatility, even though I was getting the implied move from a numerical standpoint, but not from a volatility standpoint. But I had a lot of intrinsic value because I was so deep in the money. And so these are the kind of conversations that you want to start having as an options trader. You got to really understand. And it doesn't mean that, you got to know the Greeks code. It's not about the Greeks. It's about the market. You have to understand why you believe that share price is going to move the way it's going to move, because the Greeks change constantly based on how the share price moves. The Greeks are not fixed. Volatility is not fixed. Therefore, delta is not fixed. Only thing that's fixed is the theta, which is the expiration date. Everything else is a moving target. So you got to kind of understand how the market is moving, how that's going to affect a particular share price, and then how that's going to move the options market, or how you perceive it to move the options market. You don't know until you actually see it. So this is one of the challenges that you're going to have with weeklies. However, if you can figure out weeklies because you maybe really understand that company, right? You can make a lot of money. Because what happens is you're getting a very high return on a small amount of investment. Okay. So it was another company called NTLA just moved up. For some reason, they popped. People woke up that morning, bought contracts. I want to say maybe $50, $60 out of the money. And those contracts appreciated really, really rapidly. Why? Because it was such a strong move over the course of that day. So like I said, these things happen on weeklies, but the issue is, does it happen enough for the risk that you're taking? But if you really, really understand that company, you can make a lot of money on weeklies. You just got to know what you're getting yourself into, because not only do you understand that company, but you kind of understand the market. You understand how the company trades. You understand how much institutional buy-in, which can, definitely affect how that particular company trades. You kind of understand what the beta is of that particular company. Historically, what is the volatility move of the particular company? You got to understand these things. What is going on that can move this price? And then once you understand it, then you understand whether it's worth the risk of going into a weekly contract, or maybe do you need to buy more time? But I would encourage you to not allow the price point to make you think that's a deal. And once you really understand these markets, you understand that price point doesn't always mean it's a deal. But this is how we're taught to think as consumers, is that price point means it's a deal. Because a lot of times we don't really value stuff the way it should be valued at. So in reality, it may make more sense to spend more money to buy time. Right? But if you don't really understand the value of buying that time on the contract, you trying to make the money fast with the weeklies, and not realizing is you're going to go through more money trying to figure the weeklies out than if you just bought the time and just sat in your position and wait for the thing to come to you. I showed you, you can go watch it on my community page, just to go to the GSX play. If I would have had the capital, I would have just bought the time because I knew where that play was going. I didn't have the capital to buy the time. And that's what I keep trying to get people to understand. You can kill this market if you can just buy time. You can kill it. They want you to make you think that you have to make everything come fast. If you can buy time, you can kill this market. You can kill it because you got time. And capital is about buying time. It's about a waiting game. That's why when you see, the NFL players, they strike. Why does a strike never gonna work? Because the owners aren't hurting for money. The owners aren't hurting for money. So they can sit in a position. We can not play football for 4 years. Who cares? We're billionaires. We pay you millions of dollars, most of you, because you don't really understand how to manage your money. It's not your fault. You don't come from money. So, you give a 20-something-year-old millions of dollars and they don't come from money. They don't know how to manage money. They like the average American. They're a consumer. They just running through their money. So the issue is that they don't have the money to sit. The billionaires have the money to sit. So one of the things you got to understand about capital and capitalism is really about buying time where you can sit in a particular position. You don't have to worry about your position getting eroded because you bought time. Also shows you Nancy Pelosi and her husband bought those options contracts. Those options contracts went out for years. They bought deep into the money. They bought a lot of intrinsic value and they bought a lot of time. They bought a lot of theta. Why? Because they got money. So I can spend $1 million on a contract, not on a contract, but I can spend $1 million on contracts, buy deep in the money and buy a whole bunch of time. So I don't have to worry about the day-to-day or the weekly movement because I bought myself time. And I'm very, very convicted that this particular position is going to move in this direction. And I've just bought time. So that's what I want you to really understand. You can kill this market if you can just buy yourself some time. And sometimes it means you may have to make less trades than somebody else. But I'm 100%. And you're going to realize one day that light bulb is going to go on inside your head. The same realization that I had, that if I can just buy time, I can kill this market. I know a guy, he spent, I don't know, a few $10,000, another trader I follow, buying Apple contracts. He bought at the money. He bought it till January of 2022. He's going to cash out on those. He should. Now his Apple just dumps because he bought at the money and he just bought a whole bunch of time, right? But a lot of times, because we are looking for a quick turnaround, and some of us feel like we need a quick turnaround, and I get it. But because we're looking for a quick turnaround, we take a lot more risk than what we could normally take. But my goal eventually is to position myself for plays like I'm showing you with the GSX and the go-to play, where I just buy the time and I sit back. I told so many people this company's going to collapse. That company's trading at like maybe $10 now. I was telling people about that company when that company was trading at around $100-something. So this company's done. There's another Chinese company that's also done. So I'm really good at locating these companies. I just have to be able to eventually get enough capital to buy the time because these companies are going to implode because I can look at these companies. Their financials are terrible. A lot of them got really, really shaky businesses. But because of our relationship with China, we allow these companies to trade on the U.S. stock market. So they're able to get a lot of capital, but they're really, really badly managed companies. And they're going to just implode over time. And if you look at their yearly chart, a lot of these companies since 2021, they've been going down. You got companies losing $70 and $80 and $100 over the past 6 months. That's a lot to lose on a company that was trading at $140 at the top of the year. So if you can buy the time, you can really kill these markets. But if you're trying to get that quick turnaround, it can work, but you're taking a lot more risk, which means that you can go broke on the quick stuff before you ever can get in a position to take a long-term position on anything. A lot of people see the options market and why it has a negative perception is because they see it as a quick turnaround. It's just trying to flip your money real fast. That's not really how everybody plays this market. I look at options chains. I always look out 2 years on options chains to see who's on those particular contracts. A lot of people are buying time, right? It's just that because where we may be at based on the amount of capital that we have, we're buying a lot shorter expiration because currently at this moment, that's what we can afford. What I want to try to do is help you get in a position where you can buy more time because I'm telling you, and I'm going to keep repeating to you, if you can buy time, you can kill these markets. Once you understand this market, you understand market sectors, you understand, the overall market and where it's going, you can kill these markets if you can just buy time. So hope this was valuable to you. If you know somebody that it can be valuable to, do me a favor, share it out. Wanted to get back to talking about the markets because I know we talk about a lot of different stuff, but at the end of the day, this channel is not just about the markets, but we really try to talk about how we can improve ourselves financially, put ourselves in a better position to be successful financially, increase our ability to drive in more income, increase our financial, wherewithal, our capital position. So we wanted to try to get back to that. Like I said before, be safe this holiday. Make sure you stay out of the way of any falling shells. This is David W. Williams, also known as Diamond Dave, the founder of the highest paid part-time job in the world. We're having a 4th of July sale. So for the particular courses, I believe it's 20% off, right? That is going to be the lowest price this year. Those course prices will be going up. You're getting a high level education for a few $100s. And the colleges can't teach you what I teach you. They don't have the ability to, right? Colleges can't teach you how to read a chart. So many of us have gone to college to learn how to make money. We've taken on a lot of debt and we're still dissatisfied. If you continue to apply yourself, don't get distracted, apply yourself to these markets, right? I can help you become more successful, but you got to remain consistent and remain diligent, right? July 4th is the actual discount code. The link should be in the description. This offers for people that have a desire to work towards a financial goal. If you're not part of that audience, I don't have a lot to offer you at this particular point, but we may have something in the future. This is David W. Williams, also known as Diamond Dave. Have a great weekend. Stay safe. Talk to you later.